Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jon Ferro, along with Lisa Abramowicz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Matt Miskin joins us now for more. Matt, good morning to you.
Good morning. Thanks for having me.
Great to catch up with you in person as well. It's been a while. Let's get into this Governor Waller. Is it an ignore and move on? Do you agree with Luke Hickmore of Aberdeen?
I actually thought it made a lot of sense. I thought Powell in the press conference during the Fed meeting was, he kept saying over time. It's like when I tell my children to clean their room and they're like, oh yeah, over time I'll clean the room, and then it just keeps on getting more messy and everything else. Over time, you gotta be thinking about this more with a priority. Inflation is starting to come back and you said before, data dependent. I love that. That's a great way for the Fed to think about this. But if you're going to revise up your inflation forecast and you're going to keep cuts, that's not being data dependent. So they have a communication issue right now, and I think they're going to have a tough time navigating this because the markets are really dependent on them being dovish. And if they push back, I think it's going to be tough. But I think they should, because they don't want to fight this battle all over again later this year.
Always love your storytelling, so let's run with it. Let's say the clean room is 2%, and you're less convinced they're going to clean it anytime soon. When does the bond market start to get messier, which essentially is what Lisa is asking?
So we've seen some that are saying the position with for higher interest rates because of that, the long end of the curve would see higher rates if they let inflation run like this. But in our view, it's just you're seeing a lot of value in the bond market. Yields are already up. We're in an inverted yield curve. This is the longest inversion of the yield curve ever. So the bond market's a mess in a way, just trying to interpret this. In our view, though, we stay inverted. If anything, we get more inverted. We're actually on the other side. We think they're going to take longer to cut, but then they're going to cut more than the markets expect because something will happen. They've got to push back here. They've got to be strong. They've got to be that adult in the room and tell their kids to clean their room. It's hard, but right now they're not doing it.
Well, they're not doing it. They're not being the adults in the room. They're basically saying, why don't you throw some more things on the floor? Because you know what, we'll get to it later. And this raises the question, what gives you conviction that that's the path that they're going to take if that's not the signals or the communications that they're giving and markets are running with that and they're not pushing back?
Yeah, I just think inflation coming back, growth, if our star, right? The stars of the sky. Like, you remember that analogy?
Yeah.
But if this is the neutral rate, why isn't the economy slowing? Why isn't inflation slowing? None of that's happening. It's hard to say that they're being really restrictive with high yield spreads at 300 basis points. They're trying to turn off the faucet, but the shower's still running. The liquidity is still coming into the market, and you've got to use I think that maybe this is a bigger picture conversation, but I think the Fed needs to be market-based and not academic-based or legal, a lawyer.
Got to jump in, Matt. It doesn't matter. This is who they are.
Yes.
Doesn't this scream buy stocks based on what you've heard in the last week?
So historically speaking, usually this is a time, late cycle, where the Fed is at what they think is the neutral rate. And you have to be careful because it does look good. You usually get this late cycle pop in risk assets as the Fed says, hey, we're going to think about cutting or we're not going to raise rates anymore. And then the tide goes out. Old Warren Buffett quote, when the tide goes out, you see who's swimming. But you want to make sure that you don't have that risk because if it's commercial real estate, if it's other things can break. And then all of a sudden the Fed's got to turn. And it almost seems like Powell might have something up his sleeve that's saying there's a risk here that isn't on the surface, that I'm playing this a little bit easier. And I wouldn't be surprised if there is something underneath the surface.
How frustrating is it to play psychiatrist to Jay Powell at a time where you feel like it should happen, but you think maybe he's playing games with us. Maybe in his head he knows something. I mean, this is sort of the level that we're at because people can't otherwise understand and draw the dots from what we saw in the meeting.
And they do the summary of economic projections and all this forward guidance. And back in the day, that was supposed to help because it was saying, hey, we're not doing much and we're just sitting here. Now it's almost hurting. The fact that you're saying we're going to do rate cuts before gets priced in the market immediately. And basically that was a rate cut. The way I think about it, almost like Fight Club, the movie, you don't talk about Fight Club. That's the first rule. Don't talk about rate cuts until you need to talk about rate cuts. Because if you're going to talk about it in advance, the market's going to say, great, I'm going to price that in, and then that creates the risk on, that creates the inflation impulse, and now we're going to have to deal with it all over again.
They also upped their own inflation target. So, we've been having this conversation with a lot of people about it's 2 point something that the Fed actually basically is targeting, no longer 2%. Maybe they're more acceptable of a range. Do you agree with that?
Possible. I mean, after the last meeting, I thought that. I thought 2 to 3. I mean, in the summary of economic projections, it doesn't take till 2026 that you see a 2.0. That's that overtime. That's, hey, we'll clean up the room 2 years from now. But for then, it's going to be bumpy, But Emery, it's also about the energy sector recently. Oil prices are coming up. So if you had the stocks rallying, but you didn't have the inflation impulse, that's better. But I almost think about March Madness bracketology right now.
Sure.
Energy stocks were actually one of the best performers in the quarter. Oil prices up another 1% today. If that keeps going, they're going to be hitting gas prices coming up, inflationary impulse. And there's other things, disruptions of supply chains still going on. I think they're going to have to change their tune as the year goes on.
So what are you buying?
So we still have the high-quality U.S. stocks. We're overweight U.S. versus international. We are up in cap. We're trying to find profitable businesses. We do not have some of the AI, the FOMO AI or the crypto, the mine, all that.
How hard has that been, though?
So AI-wise, NVIDIA has done pretty well. It has put on another $1 trillion in market cap last quarter. So we do have tech. We've been overweight tech. We like quality, so that helps, but at a reasonable price. On the bond side, we have been dragging because we've been higher quality, but we're willing. I look at high yield spreads at 290, I think it was last week. It was a great tweet, by the way.
Thanks.
Because we got to watch this. So the upside is 50 basis points lower is the tightest in history, or we could go 8 to 20% higher. And that's just another symptom of this market, is just how tight the spreads are. So we're not going after that. We have an underweight to high yield, overweight higher quality in the bond market. But we're getting enough on the ball on that overweight to U.S. equities, overweight U.S. large cap, have some of the tech quality names. But frankly, we're sitting here waiting. And nothing's on sale. I mean, other than high quality bonds, but it's a hard trade because the momentum factor in equities is so powerful.
I love how many people don't have a Bloomberg terminal and rely on Bramo to get high yield spread updates. Super, super tight. But the way you talk about them is if they are a reflection of complacency and not a reflection of strength. Why do you see it as the former and not the latter?
Last 2 times they were this tight was 2007, 2021. The 12 months after those real tight levels, high yield was down 3% total return. So you got about 7% yield. Total return was negative in 2007. And this is, again, going back to that Warren Buffett quote of the tide goes out. It often looks the best before it turns. The risk on the sentiment has to be stretched to really feel the reversion. And so I still think, we always think about risk management. It's part of our DNA. But right now, as everyone else is going to this side of the boat, we're saying, hey, there's some stuff that's like higher quality, defensive parts of markets. That's actually what you should be looking at.
That's sensible. I think we always just think about, when I hear stuff like this, I always have to think about things from the other side. And I'm thinking right now, I'm listening to you, the Fed, just to borrow a little bit from Soros, I'll do it the other way around, the Fed can shape the events they anticipate. And if you get Chairman Powell coming out and establishing basically having a bias to respond to weaker economic data than they would higher inflation points, it probably makes weaker economic data even less likely because financial conditions are so loose right now. When you see credit spreads as tight as they are, the way I think about it is we were really worried about the maturity wall in 25, and we've just taken a massive chunk out of it in the first quarter of 24. A high rate's less of a thing to worry about 3 months into 24 than maybe they were at the start of the year.
Yeah, but you still have in all this communication, all this analysis, all this psychoanalysis of what Powell's thinking, but at the end of the day, they haven't done anything. So we're still doing QT. We still have 5.5. We still have this huge maturity wall. Russell 2000, 45% are not profitable. There's 50, 60% of those companies that have to refinance in the next 12 to 18 months.
Yeah.
So if they don't do anything, and that's why I actually liked Waller's comments. I was like, that's refreshing. Just don't do anything. Just let it go. Sit on it. Be patient. But Powell does seem like he wants to cut. I think this is going to create more issues for him, and it's just a circular feedback loop.
Steve Rashudo Mizuho just reminding us of the last couple of weeks, if there's a chairman that wants to cut, will the data cooperate? And that's going to be the argument that gets settled later this year. Matt, it's good to see you. Secretary Yellen speaking at an event in Georgia yesterday saying U.S. manufacturing is facing pressure from cheap imports flooding the market. The comments ranging from green energy products to electric vehicles. Yellen saying this will be a key issue during her next trip to China, which is expected in the coming weeks. Steve Center, COO and Executive VP of Kia America, joins us now for more. Steve, good morning to you.
Good morning.
Let's talk about EVs. It's fantastic to have you with us, sir. You've got the EV9, the EV6 over at Kia. Can we just start with how they're selling? Because we've heard a lot about pushback in this country. How are they selling?
They're selling very well. We'd like to sell more of them, but I think there's been a lot of expectation about the rate of the transition, and that's unknown. And consumers are buying the car, they're enjoying the car. The infrastructure is the challenge. The whole industry has already received the business from the early adopters. And now we're getting into people that really need the car. This isn't a toy. They need to get back and forth. The thing about range anxiety is true, but it's more about charging anxiety because the cars will go 300 miles, and very few people drive 300 miles at a time. So we're very excited. EV9's won a lot of awards. It's proven what you can do with electric cars, a 3-row SUV. With that kind of range.
What are dealerships telling you about what they need right now, where consumer demand is, and how can you meet that demand?
Well, when you talk to dealers, their first answer is discounts, and that's not selling from strength. I think what we need is better infrastructure, and that's where all of this is failing, in a sense, because you can regulate what we build, you can't regulate what people buy. And the big projects like infrastructure that in the beginning are all cash out and then the return is over a long period of time, that's kind of like building highways, and that's what the government should do. And they've really blown it on that.
From a personal perspective, when I was buying a car, it wasn't range anxiety, it wasn't charging anxiety, it was resale value anxiety. And the fact that it was probably going to plunge off a cliff if I got an electric vehicle, because right now it's not clear, especially with an 8-year battery lifespan. How do you address that? The fact that these cars are not as valuable when you resell them, and potentially there could be new technologies that come down the pike in that time.
Absolutely. And when you're buying electric cars, they're probably more like tech products than they are normal cars. Perhaps the ownership method's going to change, and you may lease the car. You may be the first lessee on the car. It may come back at the end of the lease and get a complete refitting and a tech upgrade like an aircraft does, and then there'll be a second lessee and you recondition the battery. So there's a lot of change coming in terms of how you do things, and it might be that you don't own them. And in a sense, you don't own a car when you buy it. You only own the life of the car.
You know, John's been on this point for a long time, and he's absolutely correct. It raises this question if policymakers have gotten it wrong. If basically the car makers were pushed into manufacturing vehicles where there wasn't the demand yet, and it wasn't clear that that was the right pathway, when there could have been better ways to get to a more efficient future. Is that accurate?
Absolutely. I mean, we're being told what to make specifically. And there's many ways to skin that cat, so to speak. And if you talk to engine designers and emissions engineers, there are many things they can do to clean up the cars. And there's different technologies. Batteries one, there's fuel cells. And hydrogen fuel cells are really wonderful. Their emission is water. And they're silent, and the question is where to get the hydrogen. And I've worked on hydrogen cars for a long time, and that infrastructure is even less mature than the battery charging infrastructure. So I tell everyone that I can find in the government, you need an Oppenheimer moment. And you need to feel the crisis, and you need some leadership to manage the change.
The U.S. government now has subsidies for the EVs, and then the EPA, many people say this is basically a mandate. These are the strongest pollution standards we've ever seen in the United States. So what should have they done first? Because it seems like what you're saying is they got it backwards.
Yeah, well, there's a lot wrong with the regulation. And if you think about it, you've got 3 different groups regulating the auto industry, at least 3, at least from the emissions. You have NHTSA, which is regulating CAFE, which is a fuel economy. You have EPA for exhaust gases. And then you have California steering from the back. And they're requiring electric vehicles. And there's other states that jump on that rule, and they're not doing anything about the infrastructure. And the challenge you have is you've got too many sets of conflicting rules. And in the case of electric vehicles, the point is to reduce the CO2. And CO2 is not a local problem. When you fly over the country, you don't see the lines on the ground. It's a global problem. So California is a big EV market. You know what, like the number 3 and 5 are? It's Texas and Florida. They're not ZEV states. And my attitude is, well, let people buy them where they want to buy them right now, and let's get the job done. So tell the automakers the percentage of EVs you have to sell, it's for the whole country. Don't create these silos and buckets. That's killing the industry, and it's impossible to manage that.
The Biden administration has been very happy with the Inflation Reduction Act, able to get over the finish line, but Trump is threatening to ratchet it back. How concerned are you about that? Yeah, so someone asked me last night, what's the biggest threat that I see in this business? And I said it's an existential threat. And they said, oh, is it China? Is it something else? I said, no, that's competition. We're okay with that. It's government policy. And this whipsawing, we're making decisions that last 30 or 40 years when you build factories and establish supply chains. And to have the government policy change from on, off, it's nuts. It's just nuts.
It means you need to be really nimble. So can we talk about the EV plant in Georgia? Can you tell me whether that's going to be dedicated to battery-powered vehicles or not? How flexible would that plant be?
So that's a great question. The original concept is EVs, and it also includes a battery plant. So, because you always want to have the big, heavy components right near the factory. It might be in the future, because you always want that factory running full speed with everything you can do. It might be we also build other cars there. Now, we have another factory in West Georgia that's been around for a long time, and we build Telluride and Sorrento and other great cars there. One of the things that we've done is we made room, and we're building EV9 there now. So and most of an electric vehicle is the same as internal combustion. At some point, it goes this way or that way. And we're building EV9. We're going to introduce it later this year. So it might be that we're going to balance the capacities with other products.
How easy is it to do that? I've tried to get some information, some clarity from GM and struggled, so maybe Kia can help me out a little bit more. To toggle between hybrids, EVs, and internal combustion engine vehicles in a single plant. How easy is it to toggle between the three?
The biggest hybrid vehicle isn't that different. So it has an engine, it has a fuel tank, it also has a electric motor attached to the engine and a battery pack. It's a smaller battery pack. An EV is a totally different beast because it's driven by electric motors at the wheel. So at some point when you're building the body and the car, it's either going to be born as an EV or born as internal combustion. And that's where the difference is. So at some point on the line, you go this way, you go that way. I think that the biggest challenge is the supply chain, because you have different parts. So you have to have different motors coming in and battery packs. But inside the factory, you're either jacking up engines or you're jacking battery packs in, and it's not that exciting.
When you talk about the supply chain, you mentioned this earlier, you don't worry about China. That's just competition.
Right.
Do you think increasingly the gating off of different auto industries, depending on the country, is problematic for your business, even if it might benefit you in the short run in terms of, restricting competition on the margins with certain areas?
Yeah, well, you don't. My background's in economics, actually, and you don't want to restrict competition because it breeds laziness and weakness. So competition's a good thing. You don't like it when somebody can beat you, and often you get beaten because of differences between the nations, and you just have to get better.
Steve, this was one of the most revealing conversations, honest conversations I've had about the automakers for a long, long time, and appreciate the transparency. The policymaker, it appears, has put you in a very, very complicated place, and we appreciate your time this morning, sir. Thank you.
My pleasure.
Thank you, Steve. Steve is centre there of Kia America. CEO Robert Davis joins us now for more. Rob, good morning to you.
Greg, good morning.
Can we talk about that approval yesterday? How much of a breakthrough is this?
This is really, we think, something special. The disease we are hopefully able now to really make a difference in is pulmonary arterial hypertension. And this is a rare disease. It's not a well-known disease, but it's a devastating disease. This is a disease that primarily affects women in the prime of life, age 30 to 60. Mortality rates of 43% in 5 years. So you can imagine impact not only to the patient, but to the family of people who otherwise are in the prime of life is really tragic. Thankfully and hopefully we'll make a difference in that. This drug now we're bringing forward, it's called Winrevair. Is a biologic. It's a first-in-class medicine. It's a new mechanism of action called a activin signaling inhibitor. And what it actually does is potentially remodels the blood vessels, your arterial vessels, that allows them to open up. Because what PAH does, it causes your blood vessels in your lungs to thicken and narrow, which ultimately leads to heart disease.
How often do you take this? Every 3 weeks? How does this work?
Yeah, so it's a 3-week subcutaneous injection. Can be done by the patient or caregiver. And so this would be something you would administer. We expect most people do in home.
I wish we could go into a whole segment about how you come up with these names, Winrevair, Keytruda. We can do that another time. I do want to get a sense, though, of this whole idea of how you got into this through an acquisition to partner with someone, and then what the importance is of looking beyond some of the mainstays like cancer. It's sort of that diversity that we were just hearing about.
Yeah, well, obviously, we are a science-led, science-driven company, and this came about because we were already starting to look into this space. So our cardiovascular teams within Merck were doing work in this space. When they saw the data from a company called Acceleron that had this asset, they came to me and said, we're excited. This can be a difference maker, and that's why we moved on this. And it really now is a foundational element in our broader cardiovascular and cardiometabolic portfolio. So it is one where we see the value of diversification. Obviously, we're a leader in oncology. We're a leader in vaccines. We're increasingly moving into immunology and this move into cardiometabolic space, which is significant for us.
There are a lot of people who are listening who invest increasingly in healthcare. And all they want to hear about is, what's your solution for weight loss? Because that's really the reason why so many people have gone into the healthcare stocks and into the industry. You are working on a GLP-1 type of drug, but that's not for weight loss. It's for fatty liver. Why are you approaching this differently and not necessarily directed at the weight loss itself and more on some of the illness that potentially some of it can cause? Yeah,
well, so the mechanism you're talking about, we have a GLP-1 glucagon dual agonist, and this is important because while it brings weight loss benefits, frankly similar to what you'd see with Ozempic, our primary focus, as you point out, is fatty liver disease, which is really an untreated area today. And our view of this space is obesity is important, but increasingly it's the comorbidities around obesity. It's heart disease. It's diabetes, it's liver disease. And so if we can affect those and bring outcomes that benefit patients clinically there, they get the weight benefit, but then as you think about reimbursement, as you think about value, that's where the value comes to society, because actually we're making people more healthy than just losing weight.
Is this mostly a coverage play? Essentially, it's easier for this to get reimbursed and insured, and that's one reason why if you gear it at some of the illnesses, you won't have to get into the whole debate that's percolating elsewhere? Yeah, well, again, from a Merck perspective, it starts with the patient at the center. So we see this as a disease that needs to be dealt with. But yes, I think the benefit of this is if you can show outcome, if you can show that there's something beyond just a weight loss, then your ability to be reimbursed and the ability to show value to society is different. It will be different.
But to your point, if obesity leads to so many other health issues, at some point will insurance or the government even be able to put this under their plans?
We would expect so, yes, for sure. And I think you're already starting to see that start to shift. And it will be the outcomes-driven approaches that drive that, for sure.
We started this conversation by talking about this new drug that you've developed, got approval, stock ran away high yesterday. I was going through the cost. So the cost could be about $242,000 a year. I've always struggled with this, and I want you to explain to me, why is it so much more expensive in America compared to, say, the prices that I see for drugs abroad, in Europe, in the UK? What explains that difference?
Yeah, well, it's hard to do an apples-to-apples comparison. If you look at what drugs are as a percentage of total healthcare spend in the United States, they run about 14 to 15%. If you look across Europe, for instance, it's about the same. It's about 12 to 13%. So the reality of it is that healthcare as a total area, not just drugs, in the United States is more expensive. The percentage of cost of drugs in the United States is equal to what it is outside the United States. So it's hard to just take one element of the healthcare system and say, let's focus on it, not understanding the broader questions. You know, if you're in the United States, the thing we benefit from, you get the fastest access, you get the most access to the most innovative medicine, driven by an industry that is based here in the United States and exports to the world. You know, so we need to look at the totality of what we see as really three elements you have to think about: access, affordability, but then also making sure you're protecting the innovation ecosystem that we value in this country.
Rob, we appreciate the breakthrough. That's for sure. In the last 24 hours, a major breakthrough. Thank you very much for being with us, sir. Robert Davis there, the Merck CEO.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.